Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Welcome to FinTips, our quick little series here. We do teach you something new, get the hell out of the way, let you go get your dough straight, do all the good stuff you got to do there. Today we're talking about volatility, right? Volatility is going to be the most important thing that you focus on in 2020. It's coming, like it or not, volatility is here. We did a class for customers where we actually went through highlighting historical periods of volatility. And, well, election year, right? Volatility always peaks around election year. So I want you guys to really focus on fine-tuning your 401ks, your Roth IRAs and everything to reduce the volatility. We want the same returns. We just want to get those returns with the least amount of volatility possible. Also did a great video here on our YouTube channel to talk about that, especially with the dividend funds. I think it was called How to Build a Dividend Fund. If you want to check it out, maybe I can link it above there. All right, so Fidelity, they do all kinds of great studies, and one of them is they study you, their clients, those of you that have accounts at Fidelity's. So they found that the number of people that have workplace plans, 401ks, 403bs, etc., with Fidelity, their company actually chose Fidelity, that the number of people that had over $1 million in those plans went over 200,000. So they have over 200,000 customers now, and this was like based on last quarter, so it's probably more by now given what the market's done. But over 200,000. What they found is that the average person was someone who consistently contributed over the last 30 years. Older folks, right? Now, these aren't like 20-somethings that are rich. It's people just contributed little bits over the last 30 years. Now, I make a big deal out of that with customers. I say you contribute a small amount every week, very small, just keep it low and contribute every week versus every month. We actually did a class to highlight that advantage that you have by doing that. We broke it down by day also to show which day of the week is the best to make your contribution. Anyways, the point is small, consistent contributions make all the difference in the world. They found that workers that have been saving in their 401k plans for 10 years straight had the best record of growth. So people that just set it, forget it, the deposits, not the investments, but the deposits, they had an average balance of $306,500. Now, this is good news for those of you that are excited to do this, or you're young and you're just starting to use your 401k, or you're like, all right, yeah, I need to start putting some money away here. Because for 2020, the limit has been increased to $19,500 should you need or want to contribute that much. And if you're over the age of 50, you got an extra $500 there. You're now at $6,500 that you can contribute. Now, I say volatility, that is the most important thing here, because when the markets get volatile, you're going to make a bad choice. You're going to get emotional. You're going to want to make decisions. You're going to pay attention to your account more than you have, and volatility is coming. Now, I recently did this video, it was Monday actually. I did the video on how we should invest for Victor and Karen. Fine-tuning your 401k was the title. I'll put that above as well. And what we found here was that we were able to get Victor and Karen the same returns with a lot less volatility. So I highlighted that to show what they currently had in orange versus what we built for them, which was a less volatile but same return type over the long run, same return, but with less volatility. And you could see it right here on the chart, just a lot less back and forth, but yet trending and obviously returning the same amount there. So obviously it's a big deal for that. Now, what I wanted to do was take it a step further and say, all right, what if we just focused on a particular type of fund? Let's just say someone's out there and they're like, I don't know, Dustin, what are you saying? What should I do? What if we took a look at growth funds and we said, okay, let's just look at all the growth funds and see if we could just take a handful of them that all have the same volatility, same expense ratio, or something very competitive there, and take a look at those returns just to kind of show you what we're talking about. So here's what we did. Just to keep our opinions out of it, we just ran a real simple scan here. We went through all of the different funds that are out there. We sorted by large cap growth funds as per how the fund tries to achieve returns in their prospectus. And then we sorted them down to say we want all of these funds to be funds that are shooting for the same volatility. Not that they have done this in the past, but that's their mandate. That's what they try to do, and you could find this in their perspective. So we actually found a whole bunch of them here, and so we sorted by expense ratio just to make it a lot simpler, just so we could say that it wasn't because of some expense being higher or lower that the fund actually generated a bigger return. This also keeps us away from getting in trouble with the SEC by hand-picking certain funds and making recommendations. This is just a simple scan to return the same type of volatile funds in the growth space, large cap growth, with the same expense ratios, and then we plotted those on a chart. So here you can see we've got the volatility there, we've got the average returns there, and expense ratio is how we sorted. So they're all very, very low cost funds. And we went through and we just plotted those on a chart. Now, I'll ask you this question. Here are the returns of a handful of these funds. We just randomly chose 5 of them from the top there, because if I start adding more, it starts looking a little bit sloppy. But if you take a look at this chart here, you can see there is a significant difference in the total returns. If you go up into the gray shaded area, you can actually see, I don't know if you can see my cursor, but you can see the annualized average returns range anywhere from 12% all the way up to 18%. If you knew that these funds were going to behave the same way in different types of markets, meaning they were going to have the same volatility, the same wiggling back and forth, which funds would you choose, right? Remember I said earlier in the video, we want the highest possible returns for the least amount of volatility. Well, a really quick scan to sort through every large cap growth fund that's out there yielded a handful to choose from, right? These maybe aren't the best. You could go through the whole scan if you're able to do that. But at the end of the day, we're looking somewhere over here. We're looking at the Fidelity Fund. We're looking at the JP Morgan Fund. We want the highest possible return, knowing that they're going to behave the same. Why would you choose the lower performing fund if you know that the volatility is the same? You're getting less returns for more volatility, right? Or the same volatility as others that generate higher returns. So in this study, a quick scan finds a way to be more efficient with the fund choices you have. So assuming that you were given a list of 401k choices, 403b choices, and you had to sort through and find the best opportunities, you want to do this. You want to dive in and find the best way to do this, because at the end of the day, volatility creates bad choices. I've seen it time and time again. We're all heroes on the way up, thinking, oh man, the markets can fall, I don't care, whatever. But as soon as the old coronavirus, an election, some bad earnings, or some dip in the market causes CNBC and Bloomberg to start changing all their graphics to red, and now all of a sudden there's a bear and he's like coming out scratching the screen and everything. Well, hey, that messes with your head, messes with my head. I'm like, oh wow, this looks bad out there, right? You need to know that you are investing as efficiently as possible with the highest possible returns for the least amount of volatility. It is possible. In every case I've done this for customers, it has been possible to do. You just got to do your homework, right? Just dig in and do it. If you don't like doing the homework, maybe you'll check us out at Jazz Wealth. I appreciate everybody who's done that. Very thankful for that. So if you have Roth IRAs, you're rolling over a 401k and you're like, I don't know, I don't want to do it. I have things that I like to do. I'd rather go do other things. I hope you'll check us out, jazzwealth.com. And if this helped you in some way, maybe you'll hit the subscribe button. I do appreciate that. I will wish you a great rest of your day. And don't forget to come back later to our YouTube channel, 5 o'clock. We do the closing beat. It starts 5 o'clock live Eastern time. We'll cover the stock market, all the good stuff that's happened throughout the day. Thanks for watching. Have a great day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.